Thank you, Matt. That was a great transition. Well done, sir. Yeah, growth rates. We've been talking with fundamental focus here. We've gone from the three major categories, as I see it, with fundamental analysis, are stability, valuation, and growth. And there's different metrics for all three of those things. Not all companies are created equal, as we all know. Some companies that we talked about today, they're not yet making a profit, right? Some the companies in that ARC portfolio that we talked about, they're not quite making a profit yet, but do they still have some growth potential? Just because Kathy Wood says they have growth potential doesn't mean that they do have growth potential. What you can do is you can actually put numbers to those kind of thoughts and then formulate a reasonable opinion or an educated guess about the actual potential of something. One of the ways to do that is using a growth rate. Now, growth rates are not just for growth stocks. If I have a valuation of a fundamentally strong company, I need to know that that company is growing, right? If it's not growing, it's kind of like a shark in the ocean. If it's not swimming, it's probably dying. You know what I mean? The companies are the same thing. Even these slow, behemoth, blue chip type stocks, they still grow even if it's at a slower rate than something else. So growth rate is very, very, very important. So that's what we're going to talk a little bit about today. What is growth rate? Well, it's just a number that represents the annualized rate of a company's growth, right? So it's just taking the metric of saying, okay, we started here, we ended here, we divide that by the end, and it gives us a growth rate. So it's a percentage, which I'll show you guys on Yahoo Finance, where I am now in a minute. But the reality is we're just trying to figure out, is this company growing at a certain rate, and is it trending in the right way, right? Is it trending in the right direction? An example of this is Tesla, right? For the longest time, Tesla didn't make any money. If you go back and kind of look at their chart, they were losing. But the problem, or not the problem, was the good thing about Tesla was they were losing less. And then all of a sudden, boom, they flipped. And I don't want to say it was all of a sudden because it didn't happen overnight, but they did flip from unprofitable to profitable, and they've been able to continue that along quite fantastically. So there is growth potential in something, and looking at the great growth rate trends is a good way to see if that's a thing for a particular company. So what does growth rate include? Well, you can look at revenue, you can look at earnings, you can look at sales, you can look at dividends. All of those different things, fall into a growth rate, category. And so we'll kind of talk a little bit about those things when we start to look at the numbers here. Well, why do growth rates matter? We kind of talked about it. For starters, if you have an increasing growth rate in a company, it's probably performing pretty well. And more importantly, it's in a position to bring us more goodies like, increasing dividends that we talked about today, share buybacks, which we talked about today, better earnings, right? All these different things. If it's got a good growth rate, it's able to continue to give those things to us as investors, which is really what we're looking for, right? If we're putting our money to work, we want something in return. And it's those three things that I just named that we're really looking for, from a future perspective. So that's the first part. Now, as I kind of said earlier, secondly, if we're looking at a great growth rate, if we have a company that's not yet profitable, we can look at the growth rate and see the trend of it. Okay. And we can see, are they going in the right direction? If they're falling off on their growth rate, year after year after year, and you can't really do a one-off here. You got to kind of look at a couple of data sets here. But if they're starting to fall off, that can lead to a couple of different things here. Okay. Number one, they might be losing out on profitability. They might be losing out because of obsolescence of a product or service that they have. That's also something you want to know. Is there somebody getting into that same space and doing a better job of it, right? Maybe look at some semiconductors, right? NVIDIA, chip maker, and then you got Intel, and then you've got, what's the other one I'm thinking of? God, I'm losing my mind. Anyway, AMD was the other one I was thinking. So you got all three of these chip manufacturers there. Is one becoming obsolete, or is it losing market share? These kinds of things are important, and we can start to kind of infer from growth rates whether that's actually happening or not. So it's very important to look at those things for that. And we want to see that they're if they're not making money at the moment, that they're moving towards profitability. That's the key. Okay, so it's a very good way to split up your your value stocks with your growth stocks. You can still use a growth rate metric to look at both, but it's very important when you're looking at growth stocks. Okay, now there's two types of data that we look at. There's forward projections, forward looking data, and then there's trailing data. Okay, we got to be careful with what we look at, because forward projections are strictly projections. Not all the factors can be known when they put these things together. So we have to take that information, we have to marry it with the trailing data, and we have to say, okay, is their projections viable by looking at their history? Right. And it's recent history. It's not like we're going back 20 years. We're going back a couple of years, and we're looking at the growth rates to say, okay, if they're expecting to grow by, X number of percent going forward, have they been able to do that in the past? We can kind of look at those numbers and get an idea of whether that's plausible or not. If it's kind of out to lunch, then they might be putting too much into those future projections. Okay. So we have those two different types of information, and it's very, very important to kind of separate the two. Now, one of the things is, as an investor, growth's important because we want to know if something's in decline or whether it's just clipping along. Like, growth doesn't have to be exponential all the time. It can be steady. When you get these blue chip type companies, you just see a steady little growth as it goes along. Now, these growth companies, you can see fantastic leaps, right? But for the most part, we just want to see that it's going in the right direction. Now, one of the things that we can look at is sales data, right? If their sales are constantly falling off, okay, that can be an issue for the company. And this is where we can start to dig a little bit deeper. We can start to look at some other metrics to say, okay, maybe this company's got some problems, and I want to know these problems ahead of time, not after the fact. Okay, so important reason to look at growth there. Okay, so it's this obsolescence, it's this declining sales. These are the things that we're looking at. So let's see where we can go with this. Okay, I pulled up Yahoo Finance, just your basic page here, free and easy. Okay, you go into, I've got Coca-Cola. We've been using them though as an example the whole time. So what I want to look for here is I want to go into where it says analysis here. Okay. If I go into analysis here, you're going to see a lot of different things here. Okay. You're going to see earnings estimates. You're going to see revenue estimates. You're going to see earnings history, earnings per share trend, earnings per share revisions, and growth estimates. Okay, we need to look at all of this kind of stuff. Okay, so you can look at current quarters. I don't really go by quarter so much. What I want to do is look at the current year, and I want to look at what they're looking at for the next year. Okay, so a modest 1.3% increase for next year. And then the past 5 years, I want to look and see how they were doing. Okay, so the past 5 years were considerably lower than what they're expecting in the next 5 years. The question becomes is this sustainable? I think 2% is pretty sustainable. Will they reach these targets? We don't really know, but we want to make sure that they're moving forward. Okay, we don't just want to look at growth estimates because they are just that. We want to look at things like revenue. Matt talks about this every time we do an earnings announcement. We're talking about revenue here. So we can look at the EPS here, year ago EPS. You got quarters here. You want to see, are they moving forward? Is this number, the current year, is it going to expected to be higher for the next year? Right? You can look at average estimates and all sorts of things like that. I just kind of look at the raw numbers here. So you can see that Coca-Cola is expecting to do better next year, and typically they do. You can look at some other history to really delve into it, but we want to see that trend is going in the right direction. Sales growth is important, right? They have to expect that they're going to do better next year, right? Typically speaking, sorry, that's the next quarter. I apologize. So the next year, they're actually expecting less sales next year. Okay. Now they're actually more sales overall, but sales growth, they're expecting to fall off. Now, just because they have that doesn't mean they're not a good company. You can have one-offs, but overall, we want to see this trend going up. Okay. Earnings history, same kind of thing. They're expecting a little less next year. So they have some things that they look at that gives them an idea of what's going to go on. Ideally, we want to see this number to continue further on. Okay. And then EPS trend, same thing. We want those numbers going up. And EPS revisions are, that's just to see if they have to change these numbers. But the reality is with growth rates, we want them to be continuing in the right way. If we can see that, then it gives us a good feeling about the company. Even if you see something where it's, a year or two where they don't have increased growth, that doesn't mean the company is bad, but it does mean that you may want to pay attention to some other parts of the company. Make sure that their products or services are not going obsolete, or their market share is not getting eroded away. Very important there. So this week, growth rates is what we're looking at. It's just another way to look and see if we've got a healthy company in front of us here.